Hi guys, welcome to another episode of Investment for Babies, where we break down investment topics into little bite size for people who are totally new to investment. Today, we are going to be covering on some basic of technical analysis. I'll be covering on support and resistance specifically. We are going to show you step by step on how to identify support and resistance zone and lines, so that by the end of the video, you will be able to draw support and resistance level and use them for your technical analysis. So before we begin, do help us out by liking this video so that this video can reach out and help many others. What are support and resistance? They are levels in which you can look at on the price chart to understand price movement and setting yourself up for a low risk entry. You can think of support as a safety net, in which when prices fall, it is likely to be supported and retract at this level. Whereas, you can think of resistance as a ceiling, where prices are unlikely to break out at this level. So whenever we draw the levels, we always start from the daily chart. From there, we can reference from daily price movement and the volume level. So why daily chart? We must first understand what is a candlestick chart. The chart is a visual representation of major transactions for both the buy and sell side. A chart will show price levels and where big money decides to buy or sell, and there is where we have to take note and mark them. For example, a 5% daily movement from a 600 billion market cap company like Tesla is 30 billion. In other words, you will need $30 billion to move 5% of Tesla. Only institutional funds and banks can cause a movement. Hence, it is important to understand where these smart money are moving and look out for breakout or gaps. When there is major selling by smart money, this creates resistance level. When smart money buys up the stock, it creates support levels. Let's look at Tesla's daily chart. What we first want to do is to look for the volume bar at the bottom. They are there to tell you the amount of shares bought and sold in that day. And when we see major volume breakout on the day, that means those areas are where the smart money decides to buy or sell. We take note of these high volume places and box it up and drag it. Secondly, we take note of sudden spike or drop in prices, known as gaps. It is usually due to earnings report or other fundamental catalysts. The fundamental catalyst is going to drive the big money to buy or sell, and hence creating these visual daily gaps. What can cause gaps are usually when companies beat or miss earning forecasts. On gaps, we will mark it out with a line. So just for illustration, I will box up one gap up first and then change it to lines. After mapping out all the gaps and high volume candle, we can make sense of the chart and we can see there are different levels and zones. For price to move to the next layer or zone, it requires a sort of momentum, or else prices will bounce between the support and resistance. We can mark these boxes and lines out as support 1, 2, and 3, resistance 1, 2, and 3, and so on. The further the support and resistance level, the more unlikely the prices will break through these levels. So by knowing these levels, it is very helpful for you to set up your entry and exit price. Technical analysis can be very useful to long-term investors as well. Knowing this support and resistance level helps to lower your risk and maximize your profit. Do we use any indicators? The answer is no, because indicators lags behind, and if there is an indicator that becomes popular and works well, smart money and trading algo bots can use that against you. Okay, with that I end of today's video, and we hope that this video helps you. If you want to help us back, do consider subscribing to our channel and ring the notification bell. I'll see you next week.